Hi, and welcome back again to Tim Bigham's Big Time Options, Edges and Hedges. Taking a look today at 3 reasons why the SMH, the semiconductor stocks, this is the Semiconductor ETF, is flying a little too high. And the best way to trade for that rally to start to fade, it wouldn't be much of a video if we didn't give you a trade example as well. As we always like to do, we take what we term our fusion approach, taking a look at fundamental, technical, and most importantly, implied volatility analysis. So let's jump in and take a look, shall we? First of all, from the fundamental standpoint, here is the main components of the SMH, the semiconductor holder ETF, right? Here is the top 6 that comprise well over 50% of the ETF. Hard to get a handle exactly on the, if you will, PE or price to sales on it as an ETF. But if you look at the individual components, we certainly can. I like to take a look at price to sales simply because that's a much cleaner look in my opinion, and because Intel, if you look back, had some negative earnings that kind of skewed things until just recently. So here is 1 through 6, starting with NVIDIA, as we can see here on a price to sales basis, now trading at basically the highest level this year, right? Approaching 25 times price to sales. So certainly valuations from the lows in late March till now have stretched, to say the least. Taiwan Semi trading at the highest price to sales this year, right? And again, a huge rally from a price to sales standpoint, but the highest valuation we have seen. And you can see that the previous peaks somewhat coincided with the previous top of the market. Broadcom, AVGO, highest price to sales by far, right, this year. AMD, absolutely at the highest price to sales. You can see that huge run up in AMD valuation. Texas Instruments as well, by far the highest valuation again of the year. And Intel, which is the best performing by far the semi stocks this year after their earnings absolutely went rip-roaring, a little too much there as well, by far a rip higher here. So certainly valuations getting stretched from where they were on the lows. Earnings, as we saw in Intel, were good, but didn't warrant that kind of jump that we saw in the valuation multiple. So all of the 6 top components absolutely trading either at by far or just at the highest valuation multiples of the year. So certainly things not cheap by any stretch, built for growth, right? It better be explosive growth to justify this sort of run up. We also like to take a look, as always, at the technical analysis. So here's a chart of the SMH. You can see getting absolutely overbought, trading at a huge premium, by far the biggest of the past 12 months versus the 20-day price to sales. 9-day RSI, right? Trading, believe it or not, over 90 now. Rarely seen, right, is over 90. MACD at the highest level by far of the year. Bollinger percent B, even with the little run up we've seen in implied volatility, we'll take a look at that in a second, pushing towards 100 as well. So all of the technical indicators certainly getting stretched. And interesting to note that the SMH, basically here is the end of March, right, has been up pretty much every day in March. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12. This is pretty much flat. 13, 14, 15, 16 out of 17. The one down day, right, it closed, as you can see, 464.16 and then 463.96. So a drop, right, of basically 20 cents. So basically a flat day. So up every day this month. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 12, 13, 14, 15, 16, 17, 18. The SOX, another semi, if you will, index, didn't show this down day, if you will, because it was so minor. It has been up every day this month, the longest stretch by far in history for that. So things getting a little bit overdone simply from a technical perspective as well. And then taking a look at the SMH from a different technical perspective, here it is versus the NASDAQ 100, the triple Qs. Took a look at a 2-year chart. You can see normally fairly highly correlated, right? The divergences, right, were usually met with a pullback in the SMH here in black. You can see up until just recently we had a spike, pullback, spike, pullback, spike, pullback, spike, pullback. Now we have a massive spike, right? So we have the biggest divergence in the past 2 years versus the triple Qs. Has always ended with a pullback at some point in the SMH. When that occurs is anyone's best guess, but this is getting to historic extremes as well, certainly. So as you can see here, the last kind of spike, we saw the SMH up 105%, the NASI up roughly about 50%, right? So 50% divergence, right? Then fast forward, NASI's gone up about 7%. This has gone up 40%. So that divergence has gotten to extremes, which favors taking a guardedly short position. We'll take a look at the trade in a second. And we always like to take a look at implied volatility. That huge rally we saw in the SMH, normally a big run up in stocks will tend to have a contracting effect on implied volatility. With the market going higher, we're seeing the VIX towards the lowest level, right, of the past month or so, right, with the stocks heading towards the highs, right. Instead, we're seeing implied volatility on the SMH actually start to head dramatically higher, right? So implied volatility now approaching near the highest level. Here were the kind of March lows, right, where we saw that huge bounce, right, in the SMH. So this corresponded to this period here where we saw implied volatility because of the sell-off getting extreme. That's normal. Now we're seeing IV approaching that same level, which is certainly abnormal. You can see from Thursday to Friday, a lift across the entire term structure of volatility. And this is an interesting thing to note, right? I took a basically kind of 20-day IV generalized look. So pretty much at the same level it was 20 days ago at the lows, right? But interesting to note, right, that the put IV has actually dropped 3.5 vol points. So the put IV back then with the market on the lows was almost 50. Now it's under 47. But the call IV, which was under 40, now towards 43. So you've seen put IV drop, call IV rally, right? So that skew absolutely getting a little extreme to the call side. By far the biggest move we have seen, right? So the skew back on the lows favored the puts by 11. Normally see how the money puts trading at a higher implied volatility in calls, but a huge flip, right? Now we're seeing it only about a 3-point vol differential. So the calls absolutely starting to explode compared to the puts. The puts down from an IV standpoint, the calls actually up, which contrarily favors selling, calls here. You can see here's the options, the change from Thursday to Friday, and I kind of want to take a look at May as where our trade month will be. You can see the biggest volume there, over 100,000, a nice 6% vol pop from yesterday to today, even with the SMH, right, heading appreciably higher, which is something unusual as well. You can also see current IV percentile now at well over 50%. The actual volatility, right, is well under 30%. So IV perhaps overstating, the moves here, right? Certainly the calls now getting too extreme versus the puts, right? You can see the put delta, put IV, I should say, went down. The call IV exploded higher. And we can take a look at it in a different way, right? Here's the SMH today. You can see almost 450,000 contracts traded, pretty much, close to, 2.5 times the normal volume, right? Here it is 3 times the regular volume, right? But you can see now IV rank at the 98th percentile, a huge jump of almost 6 vol points. So options getting expensive, which favors selling them. Here's the IV, and I took a look just simply at a 30-day 40 delta call IV, right? And we're getting towards the levels from March near the lows on the SMH, right? as you can see, just this huge run up in IV, even with the SMH heading dramatically higher. So a overvalued, overbought, and overinflated IV SMH sets up, I think, nicely for a trade here. And the trade idea is not to take a, instant short position, right? Take advantage of the high IV, position out of the money, right? You can get further out of the money for the same net credit, the same distance out of the money for a bigger net credit, or kind of where we're hunting in between here. So we're looking at roughly 10% out of the money with 21 days to go, right? And selling the 555, 560 call spread for a little bit over $1. So bringing in $100, risking max $400, right? So a 25% return on risk that will be realized as long as the SMH, which is absolutely ripped to the upside, hasn't had a down day basically this month, doesn't move another 10% higher, right? And if it does, we do have the shorter term weeklies to sell some put spreads against it to further hedge the position. So hopefully it provides insight into why we're looking at taking a guardedly bearish position on the SMH here that is overdone certainly versus its normal fundamentals, its normal technicals versus the triple Q, which has had a heck of a run this year as well, but it's vastly outperforming that, right? And with IV at pretty much the highest level, right, we have seen in almost the whole past 6 months approaching a very rich option price. So we'll see if that works out or not, because as we always like to say, trading is all about probability, not certainty. So risk what you're willing to risk, right? Just because the SMH is getting extremely overbought, extremely overvalued, and the option prices, especially the calls, extremely rich, doesn't mean it can't even go further. So until next time, as always, here's the